Hey guys, today we're taking a look at the stock market. So the S&P 500 is showing that it is very, very resilient. So 3 big weeks in a row, and we're pretty much back at the all-time high. So I think it's actually the perfect time to reflect and think about the last month or so. When the market was coming down to this low, right? What was happening? There was so much negative news about the stock market, how everything's going to end, right? So I think, I just want to reflect on it, talk about it, and obviously now it is in hindsight, so it's easier said than done. But if we look back onto the YouTube channel, here we go. It's in the title, Buy the Dip, buying the recession dip. Everybody's talking about recession. They're talking about the interest rates out of Japan and how it's going to blow up the whole stock market. Those were the two pieces of negative news out at the time. And then the market started to recover. It started bouncing 2 weeks ago. And then look at where we are today. We're practically just a few percent away from the all-time high again. So the key lesson is we really, really need to reflect on this chart, the S&P 500 Road to Financial Freedom, because personally, and there's nothing wrong with it, but personally, I got a lot of negative messages, and even on the website eToro, there was a lot of comments which were just so negative. Like these comments on eToro, they don't know me personally, these people, but they were quite attacking, and I could sense, sadly, whenever this fear comes out and it actually goes towards anger, like they don't know who I am and they're sending angry comments my way, I usually know they're personally struggling, and that's a sign that they're a novice investor, their emotions getting involved, and you literally have to do the opposite of them. So it actually is a counter signal that we could be at the bottom of the dip. So, there was all that stuff talking about Japan and, how they raised the interest rates a little bit and it blew up the carry trade. And a lot of people were acting like they were experts and, that really understood all the nuances and how it related to the stock market. How I kind of look at it is I try to put a rating on it, how significant of an event is this out of 10? And, I was kind of putting it like a 1 or a 2 out of 10. And I want to put it in in comparison to COVID. So what was COVID? COVID's probably at least a 7 or 8. We might have a 9 or a 10 in the future, right? So the trend is, if we focus on COVID was the scariest event ever. That one really actually got me. That one got me. It's a virus that can expand across the whole world extremely quickly. If we're going to shut down the whole economy for it, that was the mindset, right? What happens if we literally can't leave our house and spend anything? We didn't know if there was going to be online ordering and all of that side was still going to work. In the early days, we literally, there was all those, remember those videos coming out of China and all of that? It was like there was going to be a zombie apocalypse, right? It was extremely scary. So if we look at COVID here, there's 1 big week down, 2, 3, 4, a month. COVID was a 2-year thing, right? But that doesn't mean it has to be a 2-year thing on the charts. Because if it goes down too low, which is what happened with COVID, then it actually has to find where the reality is, and it actually can start going the other way. So as the market's dropping with COVID, the cases were rising and rising and rising and rising, right? Getting worse and worse and worse and worse. And then there was an inflection point when the market actually started going up and the cases kept on, really, really started to take off. And then, we started hitting all-time highs. And that's that was as bad as COVID really started to get. So the charts are the charts and the real economy is the real economy. They are correlated, but the charts are 6 months to 12 months into the future, right? And the big point is COVID was serious and it only corrected for a month, right? How serious was this Japan thing? Not that serious, right? So, it was also a month-long correction. Literally, if we zoom in here, it was 1 week, 2 weeks, 3 weeks, 4 weeks, right? So, I don't know if it's the Japan thing, I don't know if it's the recession. it's probably even normal, you know, like, and maybe the market just needed an excuse to correct a little bit because we were getting a little bit high, close to the red upper boundary. And remember, what do these three lines mean? We've got three lines here: a red line, a white dotted line, and a green line. The red line means you're probably getting a little bit expensive. And if you start exceeding that, that's a sign there could be a major correction, like what happened here. Boom, major correction as we went out of the red line. White dotted line is fair value. You should be happy to buy something at fair value, right? And then you got your green dotted line. I mean, you got your green solid line, which is just a bargain of a bargain. So when you can truly understand this, then you can get to the mindset that, you know, I actually don't need to get scared when the market comes down. The cheaper it comes down, the more bullish I am. So I think another way to relate it is like, let's just think about these three lines as coffee prices. Right now, what's the standard coffee price in Melbourne, Australia? It's probably like, I don't know, $7, right? Let's just say $7 is now the fair value. That's a white dotted line. I'm happy, for me personally, I'm happy to pay $6, $7 for a coffee, right? Red dotted line is probably $10, $11, right? Would you still transact at $10, $11 for a coffee? Maybe. I personally probably would. Then if it goes down to the green dotted line, it's like a coffee for $3, right? Under that is like, you know, it's even cheaper. So as it goes down towards the green, you should get happier and happier and happier. And that's a good analogy. So, you know, next time the market's going to dip, you know, it's going to dip. Every few months, the market's going to dip. Please don't let your emotions get involved and just turn off the news. Don't even look at it. The news is not there to help you. The news is there to scare the living daylights out of you. So you click on their articles, and then, you know, you're consuming their ads, and that's how they get paid. It's a business model. They're not to educate you. All right, that's pretty much everything. I just highly recommend. I just want to say it again. Please pause, reflect. What were you feeling down here, and now what are you feeling up here? Maybe you're feeling a little bit of regret, like, you know, I panicked a little bit down here. Now the market's already back. I wish I bought, you know. So if you've got even a dollar cost averaging strategy, buying every 2 weeks or every month, if you were supposed to buy down here, did you actually follow the strategy and buy? Please, please, please reflect. Stick to the strategy. It works. All right. Thank you very much for this one. I'll see you in the next video.